News Talk 94.5 WPTI, 96.7 FM WTOB, and you're listening to the Wealth Guardians radio show with Doug Ray, helping you to retire the job but keep that paycheck. Good morning, Brice. How you doing?
I'm doing well, Doug. How are you?
I can't complain.
Welcome back to the studios. You've been out for a couple of weeks with the holidays and whatnot.
I was out playing. Went out to Arizona.
Excellent, excellent. How were the rounds of golf out there?
I'm getting back into it, so it was adventuresome. Let's say that.
Still a double-digit handicap?
Yeah, for sure.
All right. Well, thank you all for joining us. What we are starting here in 2024, and this is Doug's first time back in the studio in 2024, and what we are doing this year, a little bit different than last year, is we're doing a Get to Know Your Wealth Guardians Financial Advisor Question of the Week. And so we did that with Garrett last week. Garrett's not in the studio this week, but we're going to do it with Doug this week, and then Doug will ask me the same question. So the question this week is, Doug, in getting to know your Wealth Guardians Financial Advisor is, where do you see yourself retiring?
You know, that's an interesting question because I really haven't thought about retirement in, finite terms. Certainly I'll be slowing down as time goes by. But I don't see myself retiring. A lot of people want to retire to the beach or Florida or someplace like that. I'm perfectly happy right here and taking, trips like to Arizona and California and Florida and doing stuff like that.
Home base right here,
Winston-Salem,
Triad area. Very good.
Louisville.
Whenever that happens.
Yeah.
All right. Mm-hmm. Well, then go ahead and ask me the question.
All right, Brice. Your retirement's a long way away.
Oh, boy. Eons.
Where do you want to retire?
Well, I used to live off of Lake Wylie down in Charlotte, and I told myself at that point, I never not want to live on a lake or water again. I just love living on the water. So Belle and I have toyed with the idea of doing a half and a half, but would love to have a place down in Belize for half the year and then camping up here for the other. I mean, Winston-Salem Triad area is just an absolutely great place to live. I think we're generally in the top 25 or so places to live here. So why would we want to leave this area? The people here are great. The weather is phenomenal here. But once in a while, the winter months, wouldn't mind getting down and doing some diving down in the Belize and the Caribbean area. So that's my view of it. But we'll see what pans out, right? You can always have a plan in retirement, and
that's right.
Something changes. All
Absolutely.
Right. Well, Doug, what we're going to talk about here for this week is retirement planning hidden questions. And the retirement planning world is actually filled with plenty of advice and suggestions. You and I are no stranger to people coming into our door, and sometimes they have solid advice that they've been given, and sometimes they have absolutely, what was the person thinking when they told you that kind of advice that people are sticking to their guns to. So these are the questions that can help define the comfort and security of your retirement future. And on this episode, we unearth and tackle these hidden but essential questions about retirement. This should take us into both segments here. So let's go ahead and get started on this. And Doug, the first hidden question that we want to go over is, how much are my tax-deferred savings going to cost me in taxes?
Yeah, people don't think about that.
They think about taxes in general terms, maybe,
but
and
not how much their IRAs and their 401ks
That's right.
are going to cost them in taxes. We started last year doing a detailed dive into Roth conversions and that kind of thing, and I'll be honest with you, I've been in this business 36 years now, and I was stunned at how much people could save in taxes if they pre-planned and started working on it now. It is amazing.
Yeah.
Folks, I think the thing you need to realize when you read that 401k statement, it says your name, 401k, but it also should say, and Uncle Sam, because it potentially, Uncle Sam could get half of that 401k of yours. It is amazing.
Yeah, no, the 401ks are exactly like IRAs. And what does the I in IRA stand for is individual. But if somebody's got $1 million in their IRA, people have gotten used to the idea of thinking, well, I own $1 million in my IRA. You don't. You don't. And here's the idea of this, folks. When you are saving in a 401k or an IRA, you are getting into an agreement with Uncle Sam that he owns a portion of that, but he doesn't tell you what portion he owns until you start taking it out or until you turn 73 when the government forces you to take it out. Think of a business contract that you would have gotten in with somebody else where they say, hey, at a certain age, I'm going to force you to buy me out of my share, and I am the sole decider at that time as to how much my share is worth. Would you ever get into a financial, a business agreement with somebody who that was the terms of the contract with them? No. But we get into the terms of the contract when that is an IRA and that's Uncle Sam.
Yeah.
Well, you know, you ask yourself, how much faith, how much confidence do I have in Uncle Sam doing what's right by me? Most people would say, not a lot.
Not a lot.
So if the idea that scares you that Uncle Sam gets to decide at a certain point in the future how much his portion is worth, meaning when you start taking distributions from your IRA, how much is the tax is going to be on that, and he gets to decide that and you don't have a say in that, if you can get out of that contract sooner than later, maybe you should.
Absolutely.
And that's what the idea behind an IRA to Roth conversion is. Go ahead and pay Uncle Sam what he tells you now, because again, you don't own all of that IRA or all that 401k. And then, Doug, from that moment on, you are free and clear of any tax hikes that Uncle Sam might implement on the general public, because you've already paid the taxes on that, and now you're in a Roth account.
Now, the other thing I said a moment ago is how much it shocked me.
Yes.
The taxes that they paid. But the client, our client, going through our process, and they'll see this in our third meeting, they are absolutely stunned. Now, here's another impact we hadn't talked about. What about your children? When they inherit your IRA, your 401k, the current rule says they have to liquidate that thing in 10 years, totally. That's a taxable event to them. Most likely they'll be getting it during their highest earning years. Easily half of that money could go to Uncle Sam. So
that's right. I mean, if they're in their 50s when you pass away and your children are inheriting what you had saved in an IRA, government's forcing them to take that out at 10% a year, or over 10 years they have to take it all out. That could kick them up from easily the 22% tax bracket to the 36% tax bracket. That's not something you want to force on your kids.
Probably higher then.
Possibly.
Because I believe taxes are going to go up in the future.
Raise your hand if you think taxes are going to go up, then the scenario is even worse.
Yep.
That's absolutely correct. So that's the first hidden question that we want to talk about there, that we just did talk about. How much are tax-deferred savings going to cost me in taxes? If you're just tuning in, you're listening to the Wealth Guardian Show with Doug Ray. I'm Brice Payne here sitting in the Wealth Guardian studios this weekend morning. And we're talking about hidden questions when it comes to retirement planning, and questions that people don't ask themselves, or they've gotten bad advice over the years. And I want to ask you, if you think that you don't have all these bases covered in your financial plan that you should when you're going into retirement, then I want you to give us a call, 336-391-3409. We offer a no-cost, no-obligation, thorough, and Doug, I'm highlighting the word thorough there because that's the adjective that most people who go through our planning process with us use, is this is the most thorough planning process they've ever been through. There is no cost or obligation to you. All you have to do is just give us a call and organize your information and come in and sit down with us, and so we'll see what services and help we can provide you in making sure that all of your ducks are in a row for a sound financial retirement. If you're going into retirement without a retirement plan, I don't know what you're thinking. Mm-hmm. All right, so let's go on to the second one here, Doug. How much, this is the second retirement planning hidden question, how much can I withdraw from my savings each year?
Yeah, that's the big question too. Everybody says they've got different rules of thumb about this. There's been for years, there was the 5%, the 4% rule. Then I read just recently the 3% rule, which means basically what I'm saying is it's safe to take out 5, 4, 3% of your total investable asset base every year and still have a high probability of having money before you pass away. In volatile markets, that really doesn't work too well, because Yes, we've had a really good market. Last year, it was up nicely, but the year before that, it was down quite a bit. And 24 is going to be a fairly volatile year, I believe. It's a presidential election cycle. The Fed has raised rates. We might be at the end of that, but volatility is there. So you can't just say, I can take out 4% and be safe. You have to have other established ways to make sure that you don't lose your money as you go through these volatile periods.
And just paint a picture real quickly before we go into the break here. Let's imagine that you've calculated how much money you need to supplement Social Security by coming from your investments. And maybe that equals 50 shares a month of whatever. And the market is down 50%. Well, now that equals more or less 100 shares that you have to take out to get the same dollar amount to supplement Social Security. Imagine the market now recovering, but you've taken out for 6 months, a year, double the amount of shares that you had planned on taking out. That makes it really hard for your account to come back. So you've got to have some, I want to say fail safe, but some more sound strategies than just taking a distribution out same way, whether the market's up or down year after year.
The other side of that coin, just real quickly here, is that as you've had taken more money out, you have now lost forever the compounding effect of that money.
That's right. That's exactly right. And what did Einstein call compound interest? The eighth wonder of the world.
Something like that.
Yeah, exactly. Yeah. All right. So we've got to go into our break here as we do every weekend morning. But we, of course, just like we did in 2023, we've got a trivia question ready for Doug here.
Uh-oh.
And let's go ahead and get into this. Doug, you ready?
I'll try to be.
All right. On January 13th, 1968, Johnny Cash, one of my first concert I ever went to, Johnny Cash, records a live performance at this venue. The resulting album sales catapult him to a new international status. The record remains his best-selling and most famous record to date. Where was this live album recorded?
Okay.
And I can tell by Doug's look on his face, he knows exactly the answer to this.
Well, I'm a Johnny Cash fan.
Okay, great, great. All right, well, stick around for the answer to that trivia question and see if we stumped Doug and see, more importantly, if we stumped you. This is Brice Payne. With me is Doug Ray. The show is The Wealth Guardians, helping you retire the job and keep the paycheck. And this is News Talk 94.5 WPTI. And this is 96.7 FM WTOB. News Talk 94.5 WPTI. 96.7 FM, WTOB. You're listening to The Wealth Guardian Show with Doug Ray, helping you retire the job and keep the paycheck. I'm Brice Payne along with Doug Ray, and in this second segment, we're going to continue our conversation about retirement planning's hidden questions, things people get right and things people get wrong or never even thought to ask themselves. Now, we asked Doug a trivia question, as we do going into the break here, and before we get to the answer to that trivia question, I've got two questions for you. One, are you looking forward to your retirement? Sure hope so, right? Two, do you want to make sure that you're making the best financial decisions for your retirement? Well, I know that's a given right there. So if you answered yes to both those questions, then I've got great news for you, and so does Doug. We here at the Wealth Guardians offer a no-cost, no-obligation second opinion / review of your retirement plan. This is going to include a deep analysis of your assets, investment portfolio, insurance policies, income needs, risk tolerance, risk exposure, tax mitigation strategies, legacy goals, and even the fees that you are currently paying. Here's our goal. We want to help you lower your fees. We want to help you align your risk and improve your overall retirement picture so you can indeed retire the job and keep the paycheck. But the ball is in your court. You have to give us a call. So here's our phone number, 336-391-3409. That's 336-391-3409. Give us a call or visit us at thewealthguardians.com to set up your financial plan review with Doug, Garrett, and myself today. I want you to remember, the markets aren't going to wait for you. Okay, so having said all that, let's go ahead and get to the trivia question here. Here we go, Doug. On January 13th, 1968, Johnny Cash records a live performance at this venue. The resulting album sales catapult him to a new international status. The record remains his best-selling and most famous record to date. Where was this live album recorded?
Brice, that's got to be Folsom Prison.
There you go. That's the dinner bell ringing for you. That is absolutely correct. Live at Folsom Prison was recorded on January 13th, 1968, about 9 months before I was born. It went triple platinum with $3.4 million sales in the U.S. It was number 1 on the country charts and number 15 in the national album charts. It was so popular that a year later he recorded live at San Quentin, and I knew that one. I've got that record. I've got both of those, but I didn't realize that he did an international prison at Pau O'Straker. I'm not sure exactly where that's at, in 1973, and then another album, Concert Behind Prison Walls, in 1976. I like the fact that Johnny Cash was the one insistent on doing this album. His producers and his agents did not want him recording in a prison because it was going to taint his already kind of stressed image that he had at that point. It was no secret that he had had his dealings with drugs and whatnot. Right. And they thought it was, you need to clean up your image, not hang around in prisons. And he said, nope, this is absolutely, I'm a man of my religion, my faith, and that's why he always wore black. And he said, no, this is who Jesus would be wanting us to help out and lend a hand to, so I'm going to do the little thing that I can. And boy, was it the right career decision on his part for that.
Sure
so,
was.
Love that album. All right, let's go ahead and get back to things here. And Doug, by the way, I will mention that you are 100% for the trivia questions in 2024 at this stage. Good job.
Let's see what next week brings.
All right, so we're going to continue talking about retirement planning hidden questions here. In the first segment, we talked about how much are my tax-deferred savings going to cost me? How much can I withdraw from my savings each year? Let's go ahead now, Doug, and talk about how much am I really paying in fees and commissions? This is a huge subject for us.
It sure is, I'll tell you. And it's another eye-opener for the folks that go through our process, because we do a thorough examination of the fees that you're paying for your investment portfolio. Your 401k, about the only option you have is mutual funds. Mutual funds have some of the highest fees there are. And I'm not talking about what what the prospectus says this is the fee. I'm talking about the trading cost inside those mutual funds.
That's right.
People, when they come through our process, we collect all your statements and tax returns and all that on the first meeting. The second meeting is when we have already done our detailed examination of your assets. And when we pull up the fee structure, people's jaw drops, don't they, Brice?
Well, that's why we call it the eye-opening meeting. That second meeting is really where we show people, here's the risk that you're taking in your current portfolio, and here's the fees that you're paying in your current portfolio. Now, people might have a good idea of what their advisor is charging them, but most people do not know what the fund fees are in their mutual fund portfolio, and they certainly don't know what the trading costs are in those mutual fund portfolios. And so that's why we call it that eye-opening. And one, we do a comparison to what our fees would be when we design a portfolio for them, and I'd say 99% of the time, if not 100% of the time, our fees are significantly, not just a little bit, but significantly lower than the fees that they're paying through their current portfolio and their current advisor.
Almost always we can cut them in half at least. And, if you've got those mutual funds, like I said a moment ago, there's a lot of fees in there that really you shouldn't have. In fact, I don't mean to be, trampling on mutual funds, because mutual funds have a place. They're certainly good for a beginner because they're easy to buy. You can put a little amount of money in there.
Beginner's the key word there.
Yeah, but if you're about to retired, and you've got 6-figure 401ks and IRAs, you don't need mutual funds anymore. If all you did is you went to ETFs and actual stocks, right there you'd save about half.
That's right. That's right. And that's what we use.
Yep, exactly.
On the equity side of our portfolios are ETFs and stocks. We do not use mutual funds in our portfolios, and that's half the battle right there. Because again, it's not just about how much your portfolio can grow. It's about how much of that growth do you get to keep for yourself.
Exactly.
Yes, Uncle Sam's going to want his share, and there's no way to get around 100% of fees. There's always going to be some kind of fee. Even if you're trading yourself, you're going to incur your own trading fees. But boy, to limit them them down, to cut them in half is a huge step in the right direction. So that's what we want to help our clients achieve. And if you're just tuning in, you're listening to the Wealth Guardian Show, and we want to help you achieve the smoothest and most cost-efficient retirement that you can. And the way to do that is to give us a call at 336-391-3409. You can also visit us at our website, thewealthguardians.com, and set up your no-cost, no-obligation planning process with Doug Garrett and myself. We don't bite. In fact, anybody, even if they don't end up becoming a client, they will tell us this is the most thorough process we've ever gone through. We thank you for your time. We're going to consider everything that you've told us. Most of the time, people do end up becoming clients because we have shown them what we know and what they should have known and wish they had known for decades when it came to their own financial and retirement planning as well. 336-391-3409. Now, I mentioned our website, thewealthguardians.com. I want you to go to that website when you've got a minute, because under our Media Center tab, you can click on the calculators, and there is about 6-7 different calculators in there, including our personal income tax calculator, your tax freedom day calculator, your Social Security retirement income estimator, and a number of different calculators in there. There's no cost to use these, and it'll really help open your eyes when it comes to different numbers that you think you know how much you're going to need in retirement or how much taxes are going to cost you in retirement. These calculators will probably do exactly what our third meeting process does and help you open your eyes to what numbers really look like when it comes to retirement planning. All right, Doug, let's go ahead and get to our second one here. So that was talking about fees and commissions. The next one on retirement planning, hidden questions, is how will inflation impact me?
Boy, hasn't that been a top-of-mind topic in the last couple of years?
Last couple of years, we were really lulled to sleep on what inflation could do to us for about the last 15 years or so. And it really kind of popped up and reminded everybody that, hey, I'm here, and I can show up whenever I feel like it. And that is what inflation did to us.
You know, I look at the inflation numbers. Yes, they seem to be coming down a little bit. One of the things I've never cared for is the way the government calculates the CPI.
Yes.
Because they take out food and energy. I mean, come on.
Probably the two things that everybody in the United States has to pay for.
If you've been going to a grocery store the last 2 years, the prices have just skyrocketed, or they've actually taken the cartons and cut them down in size. So you don't.
Do you know
get as
why
much.
they take that out? Is there a logical reason why they take that? Because it fluctuates so much?
Volatility. That's what I've always heard. It's just too volatile.
Okay.
That's what people, they need their food, they need their energy.
Right. So. No, that doesn't make sense why they take that out of there. But let's run through some numbers here, Doug. Let's say that you calculate that you need to spend $5,000 a month in retirement. People who create their own retirement plans either won't calculate for inflation, period, and they've got just rosy outlook for what retirement's going to look like for them. Or if they do, they're using the wrong inflation. What is the 100-year average of inflation, Doug?
It's about 3.2%.
Okay, 3.2% is exactly right. Let's go ahead and take that $5,000 a month. What does that look like 5 years down the road? What does that $5,000 a month become?
It's almost $5,900.
That's right, $5,852. 10 years down the road, $6,851.
Now it's starting to get interesting.
Okay. Let's go to 15 years down the road. You thought, hey, we're going to be good just spending $5,000 a month. 15 years down the road, so maybe if you retired at 65, now you're 80, $8,019 a month.
And most people are in retirement at least 15, 20 years.
Absolutely. Well, we would hope so, right?
Yep.
And then $5,000 a month, 20 years down the road, becomes $9,387.
It's almost doubled.
Almost doubled in just 20 years. Yep. That's just the 100-year average, folks. Now, a lot of you out there might say, well, yeah, but 3.2, come on, that's not a realistic number. Let's go higher than that. We've had no shortage of clients who say, I want to use, some of them are silly and say, I want to use 10% but okay, let's say that we just use 3.5 or 3.7%.
Yeah.
The numbers are even worse.
Absolutely.
So yeah, that gets tough. You know what? The other thing that we could talk about, Doug, here is, should I allocate my investments differently during retirement than during my working years? Boy, I don't want to skip over that one. We're running out of time here, but Wow.
Yeah, I think logic has it that you need to be more conservative with your portfolio because you're not making any more money and you're not putting money into it anymore.
You're no longer dollar cost averaging.
Right.
So imagine if you were 30 years old and the market drops 50% like it did in 2008 and your portfolio drops 50%. You're still receiving a paycheck, right? So that didn't impact your way of life when you were 30 years old or 40 years old. Now you're approaching retirement or you're in retirement. The market drops 50%, so your portfolio drops 50%. That's a problem.
That is a huge problem.
All right, so you have to design your portfolio differently when you're in retirement or even a few years out from retirement than what it looked like through a majority of your years. You're moving from the wealth accumulation phase of life to the wealth distribution phase of life. You have to have a different portfolio for that. If you want a professional's advice on what that portfolio should look like, one more time, I'm going to give you our phone number before we let you go for the rest of the weekend. 336-391-3409. That's 336-391-3409. You can also visit us at our website, thewealthguardians.com. No cost or no obligation to sit down with us. Doug, any farewell words?
Happy New Year.
Happy New Year to you and everybody else out there. Unfortunately, that's all the time we have this week. I want to thank you for joining us. We hope the rest of your weekend is everything you want it to be. This is Brice Payne. With me is Doug Ray. The show's The Wealth Guardians, helping you retire the job and keep the paycheck. And this is News Talk 94.5 WPTI. And this is 96.7 FM WTOB.